Today we are going to be teaching you how to trade futures on Robinhood. Robinhood just dropped futures trading. This is a game changer, but if you don't know what you're doing, you could lose money fast. Let me break it down in the simplest way possible so you can start trading futures the right way. Alright, let's keep it dumb simple. Futures are just bets on what a price will be in the future. That's it. Imagine you're buying gas for your car. You think gas prices will go up next month, so you make a deal today to lock in a lower price. If gas goes up, you win because you locked in a cheaper price. If gas drops, you lose because you could have bought it cheaper later. That's how futures work. But instead of gas, we're trading stocks, gold, oil, and even crypto. You're not buying stocks. You're trading contracts that track a stock or index's future price. Okay, now let's talk about how you can trade futures on Robinhood. Enable futures trading on Robinhood. Open Robinhood. Go to settings, tap enable futures trading, agree to the terms. 2. Pick a futures contract to trade. On Robinhood, you can trade index futures like S&P 500, ES, NASDAQ, NQ, crude oil, and even Bitcoin futures. Each futures contract has an expiration date, but you don't have to hold until expiration. 3. Choose to go. Long or short long equals you think price will go up. Short equals you think price will go down. Set your trade size. Leverage explained simple. Futures use leverage, which means you control a bigger trade with a smaller amount of money. Example, Robinhood lets you trade a $10,000 contract with only $500. Good news, bigger profits. Bad news, bigger losses. So manage risk. 5. Enter and exit trades on Robinhood. Open Robinhood. Pick a futures contract. Choose market or limit order. Swipe to trade. Now, why trade futures instead of stocks? Let's break it down. First, availability. Futures let you trade almost 24/7, 5 days a week, while stocks are limited to market hours. This means you can take advantage of price moves even when the stock market is closed. Second, leverage. With futures, you can control a large position with a small amount of money. Stocks require you to put up the full amount or use limited margin, which comes with restrictions. Third, speed. Futures move fast. Big price swings in a short time create more opportunities for traders who want quick profits. Stocks, on the other hand, move slower and are better for long-term investing. However, the biggest difference is risk. Futures carry more risk than stocks and even options. Because of leverage, gains can be huge, but so can losses. A small move in the wrong direction can wipe out your account if you're not careful. Now let's break down the numbers that matter when trading futures. Margin requirement, $880.88. This is the minimum amount needed to trade. Leverage, 8.2x. This lets you control more with less money, but increases risk. Multiplier, $100. This determines how much price movements impact your trade. Tick size, 0.01, the smallest price movement allowed. Tick value, $1. Every 0.01 movement, either $1 profit loss. Trading hours, 3 p.m. to 2 p.m. Pacific Standard Time. Futures trade almost 24/7, unlike stocks. Settlement type, cash. You're never actually receiving crude oil, just the profit or loss difference. Last trading day, March 19th, 2025. If you still hold the contract, Robinhood closes it for you automatically. Key takeaway, futures allow high leverage, meaning big money with small moves, but also big losses if you're reckless. Each contract represents a bet on where crude oil prices will be at a future date. You can pick contracts for April, May, June, July, August, or September 2025. The active contract is April 2025. Key takeaway, futures contracts expire at a set date. You don't have to hold them until expiration. You can sell them anytime before. Bid ask spread, bid 72.66. People want to buy at this price. Ask 72.68. People are selling at this price. If you buy at market price, you'll pay 72.68. If you sell, you'll get 72.66. High-low prices, high 72.76, the highest price today. Low 72.45. live, the lowest price today. Volume 1,515 contracts. This shows how many futures contracts are being traded. Key takeaway: high volume equals easier to enter and exit trades without slippage. The spread, difference between bid and ask, is small, meaning liquidity is good. When you tap trade, you get 3 options. Ladder trading shows multiple bid-ask levels for better order placement. Sell if you think oil prices will go down. Buy if you think oil prices will go up. Key takeaway: unlike stocks, you can short futures easily, meaning you can profit when prices drop. Futures trading can make you rich or wipe you out fast. Most beginners make the same mistakes and blow their accounts. In this video, I'll give you the pro-level tips that separate winning traders from the losers. Placing the wrong order type can cost you big money. Here's what you need to know. When you hit buy or sell with a market order, you get filled at the next available price. Problem: if the market is moving fast, you might get a terrible fill, aka slippage. Limit orders equals control your entry price. Instead of buying at whatever price the market offers, a limit order lets you set your own price. Example: if oil futures are at $72.68 and you want to buy at $72.60, you set a limit buy at $72.60. Stop loss market versus stop loss limit. Stop market guarantees your exit but might give a bad fill in a fast-moving market. Stop limit protects you from bad fills but might not execute if the price moves too fast. Pro tip: use stop loss market for fast exits and limit orders for precise entries. Not all futures contracts are created equal. If you trade the wrong one, you'll get wrecked by slippage. The best futures contracts to trade have high volume and tight bid-ask spreads. In the previous video, the micro crude oil futures contract had 1,515 contracts in volume, which is decent. Avoid low volume contracts because they have wider bid-ask spreads, meaning you'll pay more to enter, exit. You might get stuck in a trade with no buyers as sellers. Pro tip: always check volume before trading. More volume equals smoother trades. Pro tip number 3, use the economic calendar to avoid fake moves. Futures traders get trapped when they ignore economic reports. Here's how to stay ahead of the game. Futures markets react hard to economic reports like CPI, inflation report, affects interest rates and commodity prices. FOMC meetings determines Fed interest rate decisions. Crude oil inventory reports directly impacts oil futures. How to stay ahead: use forexfactory.com or investing.com's economic calendar. Avoid trading 15 minutes before and after major reports. They cause huge spikes and fakeouts. Pro tip: plan trades around news events, not during them. Robinhood gives you 8 times leverage on futures, but just because you can use it doesn't mean you should. Futures are highly leveraged, meaning a small price move can cause big wins or big losses. Example: if oil moves just $1 per barrel, you could make or lose $100 per contract. If it moves $5 against you and you're over leveraged, your account is gone. Trade smaller position sizes until you're confident. Risk only 1 to 2% of your account per trade. Pro tip: trade with less size and scale up when you're consistently profitable. Having a strategy is everything. Here are 3 futures trading setups used by pro traders. 1. Breakout and retest strategy. Step 1. Identify a key level of support / resistance. Step 2. Wait for a breakout. Step 3. Instead of chasing, wait for a pullback, retest before entering. 2. VWAP bounce, intraday strategy. VWAP, volume weighted average price, acts as a dynamic support / resistance level, or buy if price bounces off VWAP in an uptrend. Short if price rejects VWAP in a downtrend. 3. Scalping with the ladder order book. Futures markets move fast. Use ladder trading on Robinhood to see price levels in real time. Enter and exit quickly with tight stop losses. Pro tip: backtest strategies on a paper trading account before going live. The biggest mistake new futures traders make: getting liquidated. If you don't have enough margin, your broker will forcefully close your trade. Robinhood won't tell you this up front, but holding a futures contract overnight comes with hidden costs that can eat into your profits. Overnight margin requirements can change. During market hours, you may only need $880 to trade a contract. But overnight margin is often higher, meaning Robinhood could force close your trade if you don't have enough funds. Settlement and rollover risks. If you hold a futures contract too close to expiration, you may be forced to roll into the next contract, often at a worse price. Pro tip, always check expiration dates and plan your exits accordingly. The hidden financing cost, interest on margin. Robinhood charges a small fee for holding leverage positions overnight. If you're using 8.2x leverage, those fees add up, especially if you're holding long term. Pro tip, futures trading is best for short-term trades, not buy and hold investing. You probably think futures trading is 24/7, so all times are equal. Wrong. Certain times of the day give you a massive trading edge. The best times to trade, highest liquidity. New York Open, 9:30 a.m. to 12 p.m. ET. Most volume, best fills, and clean trends. London, New York overlap, 8 a.m. to 10 a.m. ET. High volatility, good for breakouts. Pre-Asian market, 6 p.m. to 9 p.m. ET. Low volume but clean range trades. The worst times to trade, slippage and fake moves. Lunchtime, 12 p.m. to 2 p.m. ET. Low volume, market makers trap retail traders. Right before major news reports. Wild swings that hit stop losses before reversing. Pro tip, trade when volume is highest to avoid slippage and bad fills. Retail traders move the market a little. Institutions move the market a lot. Here's how to trade with the big players, not against them. Watch order flow, spot big buyers and sellers. Futures markets don't have level 2, but you can still track big orders. Look at the bid-ask size. If the bid side is heavily stacked, smart money is buying. Use ladder trading. Robinhood lets you see orders at different price levels. Track open interest, where the money is locked in. Open interest equals the total number of open contracts. If open interest is rising on an uptrend, big money is holding long positions. If open interest drops sharply, big traders are cashing out. Time to exit. Pro tip, follow the trend of big money, not retail FOMO traders. Most traders only think about making money, but pros know how to protect their gains. Here's an easy futures hedge trick that can save you from losses. How it works. If you're in a profitable trade, instead of closing it, you can hedge it with an opposite contract. Example, your long crude oil futures, MCLJ 25 at $72.50. Price spikes to $73.20, but you don't want to sell yet. Instead of exiting, you can open a small short position to lock in some gains. Why this works. If the price drops, your short hedge reduces your loss. If price keeps rising, you can exit the short and continue holding long. Pro tip, hedging reduces risk while keeping you in the trade for bigger moves. Even if you know all the strategies, you'll still lose money if you can't control your emotions. Here's how to trade like a machine, not a gambler. Recognize FOMO before it destroys you. FOMO trades happen when you chase a move because you're afraid of missing out. If a trade already moved 70% of its expected range, it's too late to enter. Create a pre-trade checklist. Before every trade, ask yourself, is this an A+ setup or am I forcing it? Is volume confirming my entry? Do I have a stop loss and profit target before I enter? Limit screen time. Avoid over trading. Watching charts all day leads to emotional trading. Pro traders have set hours. They don't trade all day. Pro tip, treat trading like a business, not a casino. Thanks for watching, young investors. If you want to become a better trader and master the markets, check out my channel for more in-depth strategies and live trade breakdowns. Hit that subscribe button and let's grow together.